For Chapter 14, your focus is going to be on that business unit performance measurement. So we are going to be seeing the different ways that a company can evaluate performance, whether it is just by looking at net income, looking at some financial ratios that focus solely on the income statement versus comparing it with their invested assets. Some other methods that we could use, such as economic value added, so on and so forth. So the way that I really like to put this into perspective is to consider that there are two different divisions, the Western Division and the Eastern Division. Now, here if we take a look at the Western Division versus the Eastern Division, you do see that we have a typical absorption income statement. This is like a general financial accounting income statement. And you'll see that if we looked solely at the net income of these two companies, we see that the Western Division is doing better. So as we're going through this, consider yourself perhaps a CEO of a company, and you are deciding which of these two divisions is going to get a higher bonus. So what are you going to base these division manager bonuses on? So if we were just looking at net income, we might go ahead and say, all right, so we're going to consider the Western Division to be the one to get the higher bonus because they had better net income. But there's really a few things that we have to keep in mind when we use the divisional net income as the way of evaluating their performance. Some of the advantages: it's easy to understand. The decisions controlled by the manager are reflected right in those results. They're summarized very easily. It's easy to compare. But some of the huge disadvantages is that it doesn't take into account the size of the division. It doesn't determine if the managers are making good decisions regarding use of the assets. It also doesn't let us know if perhaps there is a focus on future rather than current, so perhaps they're building their division. It also doesn't take into account how much invested assets they have. Again, we're considering size, how big their territory is. So there's a lot of things that are missed if we use this very simple way of evaluating a company. It doesn't really give us the full view of what's going on. Now, what we could do is we could take it a step further and say, okay, well, if we're concerned about size, then we could do it relational. So we could say, all right, well, how much as a percentage of sales is that after-tax income? So how are they doing as it relates to that? And so that brings us down to some financial ratios. So when we're taking a look at financial ratios, there are three main ones that we might look at. The gross margin percentage, which gross margin divided by sales. If you're focused more on what you learned in probably financial accounting, you may have heard this as gross profit. So it's saying how much of the gross profit makes up sales. The next one we might look at is the operating margin. So our operating income from operations divided by sales. So what percentage is our operating income of sales? And the big one, which is typically the biggest indicator, is the profit margin after tax income, which is essentially net income divided by sales. So let's go ahead, and I guess I'll go ahead and I'll just put it right here. Usually we write it right on the chart, but I have an image here, so it gets in the way. Let's figure out for the Western Division and the Eastern Division what their gross margin percentage, operating margin percentage, and profit margin percentage are. So for the Western Division, gross margin, 2398 divided by 5200. Eastern, gross margin divided by sales, 1285 divided by 2800. So if we were focusing on those as percentages, then we would say, okay, well then in this case, the Western Division is doing better. So let's see how it relates to the operating income divided by sales. So let's take a look at our operating margin for each one. For operating margin, 480 divided by 5200 for Western. And then let's see how much of that is left over for our Eastern Division. 306 divided by 2800. Now we're seeing that the Eastern Division actually is keeping more of their operating income. So essentially they have less costs is what we're kind of getting here. And then last but not least, let's find out what our profit margin is, that after-tax income divided by sales. So for the Western Division, $336 divided by 5,200. And then for Eastern, 214.2 divided by the 2,800. 7.65. So here we're seeing that if we focus solely on net income, the Western Division would have been the winner here. And when I say winner, it just means they would have gotten a higher bonus per, possibly. But when we change it perhaps to profit margin, then we would see that the Eastern Division is actually outperforming the Western Division because they are actually keeping more of their sales for profit. But we are noticing another big thing is that these financial ratios do not take into account how well each division is using their assets. So for example, we could say that, oh, the Western Division, yeah, they're generating a lot of sales, but they have $100,000 in assets. Meanwhile, the Eastern Division only has $20,000. So when you think of $100,000 versus $20,000, the Eastern Division would be better utilizing their assets to generate a profit. So that kind of brings us to our next possible ratios that we could use, which is return on investment. So what we're going to do now is we're going to be finding the ROI for each company. Or not quite company, sorry, division. So let's do it for the Western Division and for the Eastern Division. So for the Western Division, keep in mind there are two ways to figure out ROI. I'm going to be using this top one up here, but I do want you to know how to find ROI using the profit margin ratio, which we already covered, and asset turnover. You should be comfortable with looking up how to find asset turnover. You actually already learned about it in your lower level accounting courses. So I encourage you to look that up and know it just in case you need it on the exam. So the profit margin, the ROI, we're going to use the after-tax income. So for Western, that was $336. So they're able to generate $336. Pause. Sorry about that. They're able to generate $336 based on total invested assets of $1,500. So they're able to generate a return of 22.4%. Now the Eastern Division, they were able to generate 214.2. And what is this in millions? Thousands. That's in thousands. Good, and that's in thousands. 214.2. So $214,200 in net income. Using 900,000, or if we're keeping it in thousands, 900 in assets. So we're seeing that the Western Division has a 22.4% ROI and Eastern has 23.8. Now, if we think about ROI, our focus has to be on the higher one, really. You want as high of an ROI as possible. So based on these results now, the Eastern Division is the one, again, that is performing better. So based on the assets that they have available to them, they're able to generate more net income than their Western counterparts. Let's change it to this. Now, keep in mind that there are some limitations of really what we're doing with ROI. Now, let's bring it back. Let's see. All right, so there are some limitations when we're looking at ROI. Our focus could be on some of these things, and this is definitely something that you're going to want to read carefully when it comes to chapter 14 in the book. These two big topics: suboptimization, I would write these down, and myopia. So I'll let you guys take a look at suboptimization in your book, but myopia kind of brings us into some of our one of the topics that we're going to be covering later in this video, which is short-sighted. So for example, we might see a manager that is investing a lot of money in a lot of assets, but there isn't really a lot of net income being generated from that investment. And that is where we get into the issue of having a very myopic view, is those investments might not be generating returns during this current evaluation period, but it might be generating returns in future periods. So what we would have to do is we would have to adjust our view to keep in mind, okay, this manager, say, invested $1,000 in new equipment this period, and obviously, you know, we're seeing some depreciation from that, but perhaps this is going to be a big change later on. Or perhaps they're investing a lot of money in something like, let's say, a research and development expense. So they're investing all that money in that expense, and we're not seeing the results of that research and development. We would see this a lot with a lot of things like pharmaceutical companies, where we're not able to see the benefit of what they're doing until later, when they're able to actually produce something that will generate revenues and net income. So, and also a big thing is, if we go ahead and we focus on, the overall organization, you just have to stay above 15%, then we're going to notice that the managers aren't really focusing on achieving different areas of their division, of really achieving the best that they can do. So I would definitely take a look at those two different topics, come back to this chart, and try to understand exactly why we wouldn't want to focus just on either one specific standard, or focusing just on the current evaluation results. The next one we want to take a look at is residual income. You should remember this from managerial accounting. So we have a project that is recommended to Division S's management, who knows that their company requires a rate of return of 16%. The project requires an initial outlay of $10,000 and will generate annual after-tax profits of $2,000. So let's use this information to calculate the residual income of the project. So $2,000 is our after-tax profit. There's our after-tax net income, minus the cost of capital, which essentially we would expect them to have a 16% return, and their original investment is $10,000 is what they're going to spend on that investment. So we see that $400 is our residual income, and all residual income is saying how much above the bottom, the minimum required rate of return is it. So we're seeing that we're actually generating $400. As long as this number is positive, then they're saying they are beating that rate of return that they need. So they are actually getting a better return. And if we actually calculate it, you'll see they're getting a $2,000 return on an investment of $10,000. 2,000 divided by 10,000, that's 20%. So we're going right back to ROI here. So if they are having an ROI of 20% and they only need a rate of return of 16%, then this would be a project that they would accept. Now, one thing that might actually get into an issue is, what if this return that we were talking about, this 16%, what if, they were generating some type of return? However, it would make the company's overall division drop below the required 15% for the organization. If Division S's ROI drops below 15%, then obviously they're not going to be seen as, doing a sufficient job for their business unit. So essentially, you might notice that managers are giving up projects and giving up investments because the ROI that they generate isn't sufficient. So that's another issue that we could run into if we focus too much on these types of numbers for now. And keep in mind, this 2,000, what if this 2,000 was to be received in 2 years? Then we would have to go ahead and do an even deeper evaluation, perhaps using time value of money, which you learned in Theory 1. All right, let's go ahead and pause it here, and then we will pick up in a part 2 for this video.